Are you tired of paying so much in taxes? Did you know that a huge tax increase was coming in 2026? That big changes were ahead, including new laws, new tax rates, and new guidelines. But as it turns out, it might not be what you think. And all because of a bill you may not have heard of. No, not that kind of bill. This bill came straight from the top, and thanks to upcoming tax changes, your paycheck might just stretch a little farther. So stick around as I walk through what's changing and, more importantly, how it might apply to you. Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we simplify personal finance and provide tips for young adults, parents, and today, even seniors and retirees. So join me as we break down some important 2026 tax updates to help you take full advantage. Today's video is focused specifically on changes coming in 2026 to include tax brackets, standard deductions, capital gains taxes, and more. Now, if you're not already familiar with how the tax bracket system works, I highly recommend you check out this video on federal income tax and capital gains brackets, which explains this in detail. But if you're already a tax bracket fanatic, then let's get right into it. So first, the quick scoop. In 2026, the U.S. was facing a major tax hike. The changes from the 2017 Tax Cut and Jobs Act were set to expire, which would have not only meant higher tax rates for most, but the standard deduction, meaning the income level in which you pay zero taxes, was dropping by more than half. Instead, thanks to legislation passed earlier this year in the form of the One Big Beautiful Bill Act, the lower 2017 Tax Cut and Jobs Act tax bracket rates were locked in, and the higher standard deduction was not only made permanent, but is moving up even further in 2026, meaning you pay zero taxes on more of your income. I'll show a few real-world scenarios of what this means in terms of savings for you in just a minute. But first, let's jump right into the 2026 changes. Let's start off with the IRS 2026 standard deduction increases. This table shows the current 2025 standard deductions by filing status compared to the upcoming 2026 deductions. As you can see, 2026 is increasing by 2.2% across the board, and as a stark reminder, is over 150% higher than in 2017. In other words, 2.5 times your income is now taxed at 0%. And this is savings related only to standard deduction changes, which is a great segue to the 2026 tax bracket updates. But before I forget, effective 2025 through 2028, there's an additional deduction of $6,000 per individual or $12,000 per married couple, available for seniors age 65 or older that have an adjusted gross income below $75,000 and $150,000 respectively. Yet another provision from the One Big Beautiful Bill Act to help reduce or eliminate taxes on Social Security for most Americans. And this is in addition to the pre-existing senior deduction for those age 65 or older, which is $2,050 for individuals and $1,650 for couples in 2026. Now, let's move on to the tax brackets. The IRS recently announced the 2026 marginal tax brackets, of which the 7 tax bracket rates remain the same as in 2025, but the ranges have increased, adjusted for inflation, which is common each year. This means more of your income is taxed at lower rates, as shown here. An interesting note, while all brackets saw an increase, the lower income brackets received a 4% increase, while the higher income brackets only saw a 2.3% increase. This is good news for those in lower income ranges, where it matters most, which can help take at least some of the edge off of the inflationary price increases of the recent years, although it may not feel like it. One quick call out, another change enacted by the One Big Beautiful Bill Act was making the recent tax bracket ranges permanent, lowering the tax rates of 5 of the 7 brackets. The top tax rate also locking in at 37%, down from the older rate of 39.6%. Oh, and real quick, if you're interested, there's a link in the description below to download a free PDF of all of these summarized in a nice simple reference document. No obligation. Now, back to the video. Moving along to capital gains brackets, 2026 also received an inflationary range increase from 2025. Capital gains rates remained the same at 0, 15, and 20%, yet each of the ranges increased by roughly 2.3% across all filing statuses, meaning in 2026, a single filer could realize capital gains completely tax-free with income up to almost $50,000, while a married couple filing jointly can do the same up to $99,000, with zero taxes paid on capital gains. Now let's look at a few of the other common savings, investment, and retirement plans, all of which contain contribution limits, most that are also adjusting for inflation in 2026, benefiting taxpayers. Starting with 401k and 403b plans, total contribution limits increased from $23,500 in 2025 to $24,500 in 2026, with catch-up contributions for those age 50 or older increasing to $8,000 in 2026, up from $7,500. Additionally, the super catch-up amount for individuals ages 60 to 63, introduced with the Secure 2.0 Act, remains at $11,250 for 2026. And speaking of 401k catch-up contributions, take note. There's also a new tax law starting in 2026 that must be considered. The Secure 2.0 Act of 2022 introduced new requirements for high earners, which up until now has been delayed, allowing financial institutions and employers time to update their systems to accommodate. However, starting in 2026, if you earn more than $145,000 in the prior calendar year, all catch-up contributions at age 50 or older will need to be made to a Roth 401k account, meaning after-tax dollars. This has not been viewed very positively, and understandably so, as this removes the tax benefit provided by the pre-tax contributions of a traditional 401k. Moving forward, this could push some into a higher tax bracket or push them out of income limits, hindering their ability to contribute to a Roth IRA, for example. This does seem a little counterintuitive, since individuals over 50 are likely at the highest income levels of their career, negatively impacting the tax position of the very age group that catch-up contributions were designed to help. Moving on to IRA limits, which include traditional and Roth IRAs, contribution limits will increase from $7,000 in 2025 to $7,500 in 2026, with the catch-up contribution for those ages 50 and above finally getting an increase from $1,000 to $1,100. As far as medical savings accounts, the 2026 contribution limits for HSA, or health savings accounts, are increasing from $4,300 to $4,400 for self-only plans and $8,550 to $8,750 for family plans, while catch-up contributions for those over age 55 remain unchanged at $1,000. FSA, or flexible spending accounts, also receive a $100 increase from $3,300 to $3,400 in 2026. Check out my video here on a complete overview of HSA accounts, which is one of the most powerful tax advantage savings options available, and a super hack that most are not aware of. Now let's look at some real-world scenarios to help you understand what these new tax law changes mean in terms of tax savings to you as a taxpayer. To put this into perspective, let's compare 2017 to the new 2026 tax law changes, which include that huge standard deduction benefit, as well as the tax rate cuts. Let's start with Alex, a real estate agent and single tax filer making $100,000 annually. In 2017, she would have paid just over $19,000 in income taxes, yet in 2026 will pay only $13,000 for a savings of over $6,000 in taxes. Next, let's meet Jordan and Taylor, newlyweds earning $150,000 combined, filing jointly. In 2017, together they would have paid around $26,000 in taxes, yet given the increased standard deduction and lower tax rates, will now pay roughly $15,000 in 2026 for a tax savings of almost $11,000. And finally, for our senior viewers, let's look at Mike and Sharon, both 68 with $90,000 in income, filing jointly and incorporating the new combined senior bonus deduction of $12,000. In 2017, they would have paid a total of $10,500 in taxes, yet in 2026 would pay roughly $4,800 for a total tax savings of $5,700. Given all the new changes, after deductions, their taxable income was reduced from $76,000 to $43,750, driving a significant tax savings of almost 55%, basically cutting their tax bill by over half. So here's the bottom line. With all the recent economic uncertainty, many did not know what to expect heading into 2026, but the One Big Beautiful Bill Act didn't just prevent a tax hike, it gave us larger deductions, stabilized rates, and created additional bonuses for seniors. So whether you're single, married, or retired, 2026 is shaping up to be a more forgiving tax year than expected. So as we close out 2025, along with today's video, I hope you found this helpful, and if so, please share it with others, and be sure to like and subscribe so you don't miss future videos. And be sure to check out my video on understanding all those tax deductions listed on your paycheck here. Finally, thank you so much for watching, and I hope to see you back here for the next one. And remember, it's not just how much you save, it's how early you start. This is AJ, your ace in the hole. See ya.